my base case has been for a while that the 2020s are going to be a more inflationary decade than the 2010s. So I think basically we're in an environment of kind of financial oppression where you have bond yields super low. Inflation's currently moderately hot, by historical standards. It's hot over the past couple of decades. I think the bigger thing to watch is fiscal spending, because that's the thing that has a more durable impact on inflation. So 2020 and early 2021, we had these big fiscal stimulus bills. The infrastructure one is not really kind of near-term focused, so that's more of a long-term thing, and it's not as big as some of the others. And so right now we're looking at a fiscal cliff for 2022, where they're still kind of debating on that other bill. We'll see what they get through, and you should see a reduction in how fast money supply is growing. Now, those supply chains are still there. I mean, we're still short on truckers. We're still short on ports capacity, things like that. I mean, this doesn't work itself out very quickly. And it's also a global market, right? So it depends what China's doing with their economy. It depends what Europe's doing with their economy, some of these really big sources of demand. So I think inflation's sticky, but I think too many people think linearly. They assume it's going to be a straight line, whereas if you look at the 40s or the 70s, both those periods, inflation was not a straight line. You'd see inflation go up, and then it would cool off a little bit, and then it would go up again. And there are a bunch of factors there. There are different kind of shocks that happened to the system. There was different attempts by the Federal Reserve or fiscal authorities to kind of rein it in. There were price and wage controls in some cases. And so there are a lot of those things that impact demand and supply to watch out for. And I don't think the 2020s are going to be a straight line either. It depends on a couple variables, especially related to China and the United States. But essentially, my base case has been for a while that the 2020s are going to be a more inflationary decade than the 2010s. And that's not a super high bar to cross. So I think there's a big range for how that could turn out. And I think the biggest factor is probably what happens with fiscal stimulus in the United States, Europe, and China. That's kind of the big question for how inflationary this period is going to be. I think we're going to be in a period of kind of persistently negative real yields. So I think basically bond yields are going to be below inflation for much of the decade, regardless of how high inflation is. So if inflation comes back down for a period of time to maybe be 2%, 3%, right, it's still higher than bond yields are. Let alone when inflation officially is over 6% or, could touch 7%, who knows. So I think basically we're in an environment of kind of financial oppression where you have bond yields super low. Inflation's currently moderately hot, by historical standards. It's hot over the past couple of decades. And I think that basically we're not going to have a straight line, but the 2020s could very much see more of this. For example, I can imagine a scenario where they try to tighten policy. They kind of rein inflation in for a period of time because there's no more fiscal stimulus coming. And then you kind of start rolling over a little bit. And then, people demand more fiscal stimulus and they, something happens in markets and they do another one. And we kind of start this multi-year cycle all over again. So I think we have to watch things in rate of change terms. So partially I'm looking at real yields. And so if you looked at gold's behavior in 2020, real yields were going down. And because gold's a very financialized markets, you have to look at the financialized version of real yield. So rather than just CPI, compared to yield, you look at what the treasury market's inflation expectations are, which basically compares the tips yield to the normal yield, and you get that spread. And so that's kind of officially supposed to be the treasury market's, forward inflation expectation over a given period. But of course, the Fed is buying both sides of those bonds. So the Fed is, it's not a super clean market anymore. But nonetheless, gold has tracked that pretty closely. And so if you go back and imagine a world where Satoshi Nakamoto never existed, these other asset classes were an option. You pretty much had gold and silver as your options in addition to any sort of other property. I think gold would have seen a stronger bid. But I do think that some of them, like Bitcoin, have a reasonable shot of being around for a while. So I think we have to compare how those two kind of, you can call them kind of alternative scarce monies in different ways. They have different pros and cons. One's more portable. One obviously has orders of magnitude longer track record and other properties that make it unique. And I think we have to see how investors kind of take to those over time. Generally, a sign you see that in bear markets for Bitcoin, people are willing to sell at a loss and then keep selling. That's kind of what defines a bear market. They just want to get out of the position. Whereas in a bull market, you often see corrections go down. So they kind of get to their cost basis and then they kind of refuse to sell below their cost basis because they still want to stay in the trade. And they're like, well, I'm not going to sell anymore. And so right now we're kind of on that line. So I think right now it's too early to say. We have to kind of see what happens in the weeks ahead. I think it could certainly consolidate in this big choppy sideways patterns for a while. I think it's going to partially depend on what happens with the Fed. I think now that it's $1 trillion asset class, more or less, right? It was a little over $1 trillion. Now I think it's a little bit under $1 trillion after this correction, but it's about $1 trillion. And that brings it up to the macro level where, before Bitcoin was obviously tied to liquidity, but it was mostly its own thing. Whereas now it's big enough that, macro forces can influence it. Wall Street's involved. And so they could sell it. And so my overall kind of forecast is for volatility, and I don't really have a clear kind of near-term 6-month forecast until I see more data. So really, I'm kind of watching multiple asset classes rather than, say, focusing heavily on that one. I think that there are a lot of value stocks that are pretty attractive. Healthcare, for example, was sold off because of impending regulation that looks like it won't be as severe as some thought. And that's caught a little bit of a bid in this recent weakness because, they have risks, but really the economic cycle is not really one of them as far as healthcare sector is concerned. So that place looks attractive. And in general, I mean, even some of these former bubble stocks that are down 60, 70% from their highs, there's a certain price where even some of those start to become attractive. And so I do think that you could have a stabilization. Ironically, what we see in the past is that when the Fed tightens, it's actually pretty good for the stock market. And generally because they're only able to tighten when the economy is reasonable enough that they tighten and they're able to keep doing it. It's really when the Fed tries to tighten and then weakens, and then they start going dovish. That's when you start to have kind of troubles. So I'm kind of watching a couple indicators to see what happens. I mean, if they make it clear that they're kind of out of touch in some way. So for example, in 2018, Powell said he's on autopilot with tightening, and the markets threw a fit. Right? So that was an example of for a while they were tightening and the market liked it. But then towards the end of it, when they seemed like they were just going to go full speed ahead, the market threw a tantrum. And so, right now we're kind of in the early stage of tightening where you're tightening from a negative base, right? You're tightening from zero rates and $120 billion a month in QE. I think there's still potential little ways to go. We'll see how the market behaves. Overall, I would kind of focus on certain sectors over others. I think there's a lot of fear in the market, which I think, makes the contrarians kind of bullish. But we also still see that, especially among the really big technology companies, valuations are still pretty high. There are pretty attractive healthcare stocks trading for like a price to earnings ratio of 9, for example. There are home builders trade, sometimes they're viewed as risky, right? Because healthcare, you have to deal with regulation. Home builders are a very cyclical business. They got killed after the subprime mortgage crisis. I think conditions look a lot different now. And so there are these pockets of the market that are like, not only are they not expensive, they're actually cheaper than normal. Same thing, if you look at international markets, a lot of them are cheaper than normal, right? I mean, you can get actually high quality Japanese stocks that, they're paying 5% dividend yields. They have more cash than debt. They're not going to get you rich like, buying dog money at the right time and, getting out. It's not exciting to people, but there are pockets of value around the world and in the U.S. In certain sectors. And a lot of that high valuation is concentrated in a couple areas. So it was concentrated in some of these unprofitable new tech names.